And welcome back to another Econ podcast with Mr. Hagan. And on this Econ podcast, we're going to continue to talk about investing. Before I do, I just want to remind all viewers that this video is not designed to be investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. Okay, so let's get back into talking about the stock market. And what I was talking about on a recent video was the second theory of investing that I'm talking about, and that's we called castle in the air. And we said that castle in the air, instead of using earnings and dividends and yields and P ratios and things like that to try to figure out whether or not to buy a company, instead we are going to use graphs to decide whether or not to buy a company. So let's talk about that a little bit more. So first of all, these guys are sometimes there's four different maybe names that are used to describe these guys. I've been using the term castle in the air. Okay, some will also call this the greater fool theory, as we talked about in the previous video. But I also want to say that this is also sometimes called technical analysis. Now, technical analysis is more than just doing the price charts that we're looking at. There's lots of other things they would look at, but of course, I'm just doing a very introductory kind of thing. But sometimes it's called technical analysis, and the people that do this sometimes are called chartists. Chartists because they're looking at these kind of price charts all the time. So anyway, let's look at a price chart, and here on the horizontal axis we have time. So this is the share price of the company over time. And up here on the vertical axis, we have the share price for the company, whatever company it is that we're thinking about buying. And here's share prices. Now you can ignore a lot of the other writings that they have on here. I just pulled these charts from some images online. This one actually comes from bigtrends.com. And what we have is a share price going up and down for some company, whatever this company was. And one pattern that we sometimes see develop, or at least that these castle in the air guys would say that they see develop, is what is called a head and shoulders pattern. So what does the head and shoulders pattern look like? Well, this company, the share price was, kind of going up and down, following some pattern. And then all of a sudden we see this pattern. We see a pattern of what we call a shoulder. So that's here where the share price is going up. Then the share price comes back down, and it comes back down right to where it was before, and then it starts to rise again. And then it starts to go back up, hits another peak, and then it begins to fall again. And it falls back to where it was before. So again, we keep establishing this lower range that it keeps bouncing off of, and then it goes back up again and comes back down again. And that is called a head and shoulders pattern. That's what I have right here. That is called a head and shoulders pattern. So here's the pattern, and of course they have that. They have it here as well. You have the shoulder. That's the first kind of go up and come back down. Then you have the head, which is typically bigger, goes up and comes back down. And then you have the shoulder, goes up and comes back down. Now here's the argument. The argument is that when we see this pattern in the stock market, when you see that pattern is going to get broken right here. Right here. As it comes down off the second shoulder, one of two things is going to happen. Either it's going to bounce off that lower trend line, it's going to bounce off that line and go up, and if that happens, then that would be a buy signal. Okay, that would be a buy signal. If, on the other hand, it pierces through that trend line and goes down, then that is a sell signal. That would be a sell signal. So the question just comes to what happens right here at the end of this head and shoulder pattern. At the end of that pattern, what happens after the stock price comes back down and hits this bottom trend line? Now, that bottom trend line is sometimes called a neckline. Okay, That's a support line that we talked about on an earlier video that is sometimes also called the neckline. So you get a shoulder, comes back down, hits a minimum, goes up, comes back down, hits a minimum, goes back up again, comes back down, hits that same minimum, that same neckline for a third time. Now what? If it bounces off it, it's a buy signal. If it breaks through it, if it pierces down through it, then it's a sell signal. Now, why? Why does it work this way? Well, remember what the argument is. The argument is that what these Castle in the Air guys would argue is we've seen this pattern before. We've seen this pattern in markets before. And after you get a head and shoulder pattern, then you tend to hit a minimum or hit that minimum again. If you bounce off it, what we see when we look at charts in the past is then the stock rallies. And that's why this becomes a buy signal right here. On the other hand, if it pierces through the lower trend line, then the stock tends to go down, and that's why we would sell it right here. Okay, so we're making decisions about the future based on patterns that have been seen in the past. That would be the argument. Does it work every time? No, obviously it does not. And a firm foundationalist would just say, I think most firm foundationalists would probably just say it's nonsense. This is like doing astrology or something like that. There's no real science behind this. So I just want you to understand this isn't like some guaranteed thing that always works. So you know it's up for debate how well these different theories work and which theories are better than others. Okay, let's look at another example of the head and shoulders. Because I want you to see that the head and shoulders, it's not always just a nice flat neckline like we have here. Okay, sometimes that head and shoulders can be, you know, like sloping up. So here we get a left shoulder right here, hit a minimum. Then we get the head, come back down, hit the neckline, but it's a little bit higher now this time. And now we get another shoulder and we hit the neckline, which is yet a little higher again. Still, it pierced through the lower trend line. It pierced through that neckline. So this would still be a sell signal right there. Okay, it would still be a sell signal right there because we still pierced that lower trend line. Now, keep in mind also that this is, it might look kind of easy. Let's go back to this example. This might look kind of easy as we do this. I'm going to cover my screen here for a second. It might look easy as we do it because we can see the whole graph at one time. But remember, if we're a trader, if we're actually watching a company, here's what we see in real time. We don't see get to see the whole graph. We get to see the share price in real time. Oh, going up, coming back down, hits that neckline, goes back up. Oh, wow, maybe we got a head and shoulders developing. Comes back down, hits the neckline again. Then it begins to rise again. And then it comes back down and hits the neckline. See, as we're watching it, there's no guarantee that it's going to play out this way. There's no guarantee it's going to follow this pattern. And so we just have to watch the stock over time. We don't get the luxury of getting to look at this whole graph. Okay, we're only seeing where it is at some current point in time. Okay, so that's something important to keep in mind. All right, let's look at one more pattern. That was a head and shoulders pattern. This one, by the way, came from traders.com. Here's another head and shoulders pattern. This head and shoulders pattern is from commodity.com. And on this head and shoulders pattern, it's actually a head and shoulders, inverse head and shoulders, or they call it a reversal head and shoulders. So again, keep in mind, I should be careful about this. This down here is time. And this up here is the share price. This is the price. And we're getting now a head and shoulders pattern, but it's inverted this time. So this time, the left shoulder's going down, comes back up, hits the trend line. Then we get the head, comes down farther, comes back up, hits the trend line, comes back down for the second shoulder, for the right shoulder, hits the trend line. And so now right there, this is the key point right there. What's going to happen now? Are we going to come bounce off that and keep going down? Or are we going to break through that trend line? If we break through that trend line, if we pierce that upper trend line, if we pierce the upper trend line in this case, if we pierce the upper trend line, then that's a buy signal. Okay? Then that's a buy signal, and boom, the market is off and running to new record highs. So this is where you would want to buy. Again, I want to say this one more time. We don't get to see this thing happening. We don't get to see the whole graph at once. We get to see this playing out over time. So here we're just watching this stock. We don't know what's going to happen to it yet. Oh, the stock went down. We don't know it's going to be a head and shoulders. And then we just watch and we say, oh, well, okay, look, it came down, came back up. Oh, went back down again. I wonder if it's going to keep going up. Oh, yeah, it is. Okay, well, this could be a head and shoulders developing. And you continue to watch it, And then right here, you get excited because something's going to happen. It's going to pierce the upper trend line, it's going to bounce off the trend line and go down, or pierce the upper trend line and go up. Once it pierces the upper trend line, now it's a buy signal, and there it goes. Okay, so those are some of the patterns that the Castle in the Air guys would look for in the marketplace and use those as buy and sell signals. All right, this has been Mr. Hagan talking about the head and shoulders pattern in the stock market. Thanks for joining me, and we'll see you on the next Econ Podcast.